All right, we're going to start with problem number 20 on page 128. So and it's the same fact set for problem number 20 through 22. So it gives you a balance sheet of the subsidiary on for Abernathy, because Chapman Company buys 100% of Abernathy, and then Abernathy's trial balance at on January 1, 2014 is given you as far as debits and credits, and looks like alphabetical order for some odd reason. And then it says during 2013, Abernathy had net income of $80,000 and declared and paid dividends of $10,000. So assume that Chapman acquired all of their common stock for $490,000, and then on the acquisition date, they had land with a fair value of $90,000, buildings were valued at $160,000, and equipment was appraised at $190,000. So let's go over those first. So land on this trial balance has a book value of $80,000. So I'm just going to put that over here. So acquisition was $490,000. The book value is $400,000. And that's if you add up all of the assets and subtract out all of the liabilities for those. And you can see the $400,000 is made up of $250,000 common stock and $100,000 of retained earnings and $50,000 of additional paid-in capital. So those three credits make up that $400,000 book value. Or you could add up all the assets and subtract all the liabilities. So that means there is a $90,000 excess of fair market value over book value. So we have three assets that are specifically identified as having a fair value that is different than the book value. And that is land. Land had a book value of $80,000 and a fair value of $90,000. So $10,000 in land. Buildings. Buildings had a book value of $120,000 and a fair value of $160,000, so $40,000. And they have a remaining life of 4 years. And then equipment had a book value of $200,000 and a fair value of $180,000. So equipment was less by $20,000. And it has a remaining life of 5 years. All right? So if you add all that up, you get $30,000. That's the total of specifically identified assets with a difference, not necessarily an excess, a difference between fair value and book value. All right? So 100 plus 40 is 50, minus 20 is $30,000. So what does that leave you? $60,000, which is what? Goodwill. All right, everybody good so far on the calculation of goodwill? Okay. So, what is the excess amortization for the building and the equipment? And I'm just going to put that down here. The building is going to be a $10,000 increase per year for 4 years in depreciation expense. The equipment is a negative $4,000 decrease in depreciation for a net of $6,000. So far, so good? Okay. Did you follow me? Yes. Entry S. What are we going to eliminate in entry S? All of the stockholders' equity. So common stock, which is $250,000. And what I'm going to do here is, this is 12/31/14. Okay? Because we're eventually going to do the same thing for 2015. Additional paid-in capital, $50,000. And retained earnings on January 1, on the date of acquisition, January 1, not January 10, which was $100,000. And that made up our $400,000 book value that we had at the date of the acquisition. All right? What's the credit for the S entry? Investment in Abernathy. The A entry, we're going to increase land by its $10,000 book value in excess of, fair market value in excess of book. We're going to increase buildings, $40,000 at the end of year 1. We're going to book our Goodwill for the $60,000 calculation that we just made. And we're going to decrease the equipment by $20,000. All right? So that's $110,000 were the debits and $20,000 were the credits. We need $90,000 more in some sort of credit. And what are we going to credit? The investment. And what will that take our investment account to? Because our investment account was $490 at acquisition. 0, except that we've got some other things going on in there. Right? I. Well, hold on. I'll keep it in order. Your book always does the I entry next, and that doesn't spell Sadie, so I changed it because it drove me crazy. They had a perfectly good acronym, and they didn't use it. So, D entry. The D entry is a debit to the investment account for the $10,000 dividend, and a credit to dividend revenue. Because that's what was booked at the parent level. Right? The I entry. This is a credit to the equity in subsidiary earning of $74,000, and then a credit to the investment I was hoping you'd ask that. How much was the income in the subsidiary that they earned in that year? $80,000. And then what did we do with the excess building depreciation and equipment depreciation? We reduced the equity by the $6,000 in excess depreciation expense. God bless you. Yes, that made up the 74. And then E, we have a debit to depreciation expense for $6,000, a credit to equipment, I'm sorry, a debit to equipment, because we reduced the equipment on the consolidated basis by $20,000. Now we're going to put 4 of it back. Oops. And then a credit to buildings for $10,000. All right? We good so far? My robot's too high. Just put it off the bottom. Come on, let's go down. Oh. It's not going to work, is it? There it goes. Ain't technology wonderful when it works? Oh, and it worked the past time, the first lecture. So the iPhone's working. All right, so what is going to happen? These same entries, SADIE, are going to be made for 12/31/15. God bless you. The 250 is going to remain the same. The 50 and additional paid-in capital is going to remain the same. What's going to change with retained earnings? What's the retained earnings balance on January 1, 2015? It was $100,000. The subsidiary booked how much in net income for the year? $80,000. That makes $180,000, and they paid how much in dividends the first year? $10,000. So we have $170,000. God bless you again. You're allergic to consolidating entries. Add all that up, it's now $470,000. Did I lose anybody? Okay. To the 170. You started with 100,000 at acquisition. Agreed?
Yes.
Net income was 80 last year. At the end of 2014, you had 80,000 in net income. That's 180. And then you paid 10,000 in dividends. That's 170. The land on the A entry is still the same, as is Goodwill. What's the building unamortized, undepreciated balance in buildings now at the end of year 2? You had 40,000, but you've already depreciated 10 of that difference. 30,000. Equipment had a reduction in fair value over book value of 20,000, but you've already taken 4 of it. So what's left undepreciated as far as equipment goes? 16. See how you guys are getting this? And that leaves you an adjustment for investment in Abernathy of 84,000. Because this all totals up 100,000 less the 1684, which is just the 90 from last year less the net 6,000 difference in depreciation. Everybody good?
And all of these depreciations calculated at straight line?
Yes.
Okay.
Yes.
We can always assume that.
Absolutely.
Okay.
It's complicated enough without having to do all the rest of that. All right, so in 2015, they had income of 110,000, but you still had the 6,000 net of depreciation. So the income, do the D entry first. Dividends. How much were dividends declared in 2015? 30,000. Net income was a total of 110, but you took additional depreciation of 6, so the I entry is 104. And then this E entry for 2015 is exactly the same. The net depreciation expense is going to be 6,000. You're going to increase the equipment by 4,000 and decrease it by 10,000. And that's it. How hard is that? So now let's do it on a worksheet. Problem number 28, which is on the bottom of page 132 and the top of page 140. Well, I'll wait. Does everybody have this? Has everybody got this written down? I can lower the screen. Yes? All right, on this one, Patrick Corporation acquired 100% of O'Brien Common stock on January 1 for $550,000 in cash. They reported net assets with a carrying value of $350 at the time. Some of the assets were either unrecorded, having been internally developed, or had a difference in fair value. And then it tells you what those assets are. There's a trademark that has an excess of $100,000. There's customer relations with a 5-year remaining life of $75,000. There's equipment of book value $342 and a fair value of $312. So a reduction in equipment for $10,000. Any goodwill is considered to have an indefinite life and no impairment during the year. And then it gives you this. It gives you these trial balances, okay? And it continues on down here, but it gives you the trial balance for the parent company and the O'Brien. All right? Everybody with me so far? Okay. So first off, what is the calculation for goodwill? Let's just do that over here. So what was the acquisition cost? What did they pay for it? How much? $550. And what was the book value? It says in the problem. How much? $350. Thank you. So that's a $200,000 excess. So we have 3 assets that have a difference between book value and fair value. And so they are, what was the building? Is that trademark? And how much was it? Higher? It was higher by how much? $100,000. The customer, 75. Was it 70 or 75? 75. And then the equipment, was it? Minus 30. So that's 145, leaving us with 55,000 in goodwill. Okay. Now we can go back to the worksheet. All right, what's the first thing we're going to do? We're going to eliminate the S entry. Oops, that's liabilities. And all they have is a common stock account, which had $100,000 in it. And the offset goes to where? The investments. Well, actually, let's do this first. Do your second one up here. Retained earnings at the beginning of the year. Because that's the $350,000 book value. Is the beginning of the year, at the acquisition date, retained earnings, plus the stockholders' equity, the common stock. So this entry is $350. All right? Everybody with me so far? Yes? Okay. What's next? The allocation of the fair value. So the trademark had a $100,000. The customer relations were $75,000, and the equipment was a reduction of $30,000. And this is all A. So the remaining debit is this plus this minus that. Okay? So the A entry is the increase in trademarks, the increase in customer relations, minus the decrease in the $30,000 for equipment. And now we're too low. There we go. Okay? D. It says on here, dividends were paid, except dividends are a debit balance, so you need to eliminate it. You need to credit the dividends by $80,000. And the offset, the investment account. Okay? That's a gimme. That's an easy one. You just got to read the trial balance. Everybody good so far? I. It tells you up here what the net income is. What the heck's going on here? Oh, it tells you up here. I didn't scroll up far enough what the net income is. So I'm sitting here going, where's my $210,000? Oh, God. Too funny. And the other side of that, the investment account. Oh, you know, what did I forget? Look, there's still a balance. By the time you get to I, that should go to 0. Everybody else see what's off? Goodwill. Goodwill was not booked in the A entry. So you need to adjust this plus that. And there it is. The investment account goes to 0. That leaves us the E account. And the E account is going to be a decrease in depreciation for the equipment of $3,000, because that equipment had a useful life remaining of, let's see, where is it? $10 years. 10 years remaining. So that $30,000 is $3,000 in depreciation reduction. All right? Because they're over depreciating it at the O'Brien level. So you need to reduce depreciation expense by $3,000, and then the customer relations, which has a $75,000 remaining value, has a 5-year remaining life. And so that's going to be $15,000. And the net of that is, you're going to put down here in equipment, you're going to put the E entry here. I'm sorry, customer relations. You're going to put the E entry here to offset that. So that's the $15,000. And then the E entry here to offset the depreciation, which is $3,000. Oh, I put too much. 30,000. There we go. And everything's correct. Here. Can make that smaller. That way we get the whole thing on there. Yeah. Yeah.
I thought for the income you debited to investment credit.
Well, net income is a credit balance. So to eliminate it, you'd have to debit it. Because you see, anything with a bracket around it is a credit balance. So everything on here, revenues are credits, all the expenses, cost of goods sold, depreciation, amortization are all debits. So to eliminate the credit, you've got to debit it. And then, because what happened when you booked it at the parent level? When you booked it at the parent level, you would have debited the investment account, increasing it, and credited the equity income in subsidiary. Now you're just reversing that entry. Okay?
So right now we're looking at the subsidiary.
Consolidated level. We're not booking any of these in reality. I know the first example I did looked like journal entries, but they're not journal entries that goes into anybody's general ledger. It's only for consolidated worksheet purposes. Okay? Does everybody understand that nuance? None of these are journal entries. It's only for purposes of doing this consolidated worksheet. Yes? Ready to do one more? Okay. Problem number 30. Starting on page 134 and continuing on page 135. So Giant acquired all of Small Company's stock on January 1, 2011. Now this is key. 2011 is the date of acquisition. Over the next few years, they applied the equity method of recording the investment. At the date of the original acquisition, $90,000 of the fair value price was attributed to undervalued land, while $50,000 was assigned to equipment having a 10-year remaining life. The $60,000 unallocated portion of the acquisition cost was viewed as goodwill. So we have land that has a $90,000 excess over book value, $50,000 in equipment with a 10-year life, or $5,000 a year. And then what dropped out the bottom on our acquisition was $60,000 in goodwill. And that has also an unlimited life. All right? So the only thing for this purpose that we're dealing with is the equipment with a 10-year life. We acquired it on January 1, 2011. It is now December 31st, 2015. All right? So 4 years. Well, 3 prior years, and we're at the end of the 4th year. Okay? All right. There we go. There's all of it. Well, let me go up one. All right. There's all of it. So what are we going to do first? What do we always start with? The stockholders' equity, the S entry. God bless you. So that's $170,000 in common stock. And here, what are we going to take? I'll give you 2 options. Are we going to take that retained earnings at $650,000, Or we're going to take this retained earnings at 620. 620, thank you. You guys remembered. And then the offset is investment in small, which is that plus that. So the S entry is $790,000. All right? Everybody good so far? The A entry. Now here's where it gets a little tricky. The land, we know, has a $90,000 increase of fair value over the book value. Land is not depreciable. It has an indefinite life. So it is always going to be a debit of $90,000. Goodwill, we calculated at $60,000. Everything good so far? Now here comes the tricky part. If you remember, the equipment had, at the date of the acquisition, a $50,000 excess of book value over, fair market value over book. But we've been slowly chipping away at that excess by depreciating it year after year after year. We made the acquisition at 2011. So we depreciated it $5,000 for 2011, 2012, 13, and now it is 2014. So what's the A entry? Very good. The remaining unallocated increase in equipment is $30,000. And so the A entry in total equals that plus that plus that, or $150,000. No. Except that the Goodwill was $60,000, not $30,000. Why didn't anybody tell me that? Come on. I've been up a long time today. You guys are supposed to catch simple mistakes like that. All right? So $180,000 is the credit to the investment account. The D entry, dividends declared up here, was $110,000. All right? Everybody good with the D entry? So just a debit to the investment account and a credit to the dividends declared. The I entry is equally as easy. It tells you it's a $135,000 credit balance. So we need to debit the I entry to eliminate the equity income of small. And what happened to our investment account? It went to zero. So when you get around in the next 2 weeks of doing your eliminating entries, once you get S through I, that investment account should go to zero. If it does not, something's wrong. All right? And in 2 weeks' time, I'm going to be in my office during class time, because that you've got a work day. that night. It's no class. So once we get through Chapter 4 next week, the week after is just for you to focus on your midterm. Now, don't wait until Tuesday night if you get stuck. Email me the problem. On your problem somewhere, tell me which version it is. You've all got a version number on your spreadsheets. All right, tell me what version number it is, and then I can email you back as to where you're going wrong, because I can look at your calculations. Do your calculations in Excel. Don't do them off on a piece of paper someplace and plug the numbers in Excel. Okay? So somewhere on a tab, do your calculation for Goodwill. Allocate the purchase price, allocate the book value, come up with the excess. All right? And then allocate the excess to the identified assets and liabilities. It's all assets. Calculate your Goodwill, and then be able to plug in your A entry. So do that on the spreadsheet someplace, and then carry it to the spreadsheet. Okay? Good? All right. And it's at the end. It's at the end of the first year of acquisition, so you won't have this like we had in this problem, that issue of having to keep track of the depreciation and amortization and lower it down. The midterm problem is at the end of the first year. All right, one last thing. It says here, somewhere, on the page 134, it says small owes giant $10,000. So what do you do with intercompany receivables? Small, the subsidiary, owes the parent $10,000. So inside this current asset here, this $398,000, $10,000 of that is a receivable from its own subsidiary. Conversely, inside this $368,000 liability is the $10,000 that they owe the parent. Now, does that sound fair to anybody to present it that way? What if it was $10 billion? Right? You need to eliminate it. You can't owe yourself money when you get to the full consolidated. So this is what is known as a P entry. So we've got to reduce the asset by $10,000, and we need to reduce the liability by $10,000. I don't know why it says try again there. Let me see. I've got everything. Oh, I didn't do the other side of the E entry, that's why. This is A, not E. Didn't do the E entry at all. So what's the E entry for the current year is the $5,000 depreciation. And that is depreciation expense for $5,000. Now, thank you. Now it's right. Okay. All right?